All right. Well, welcome and thank you for coming today. Let me just share my screen real quick. Today we are joined by Ellis Hammond, and he will be presenting Unleashing the Power of Wealth, Strategies to Multiply Your Money, Secure Your Future, and Make Every Dollar Count. A quick disclosure. The views expressed by speakers at the CAMA webinars are those of the speakers only and may not reflect those of CAMA Plan, its members, or employees. CAMA Plan does not guarantee the accuracy of information provided by the speakers or attendees. Professional advisors should be consulted before implementing any options presented. CAMA Plan absolutely does not endorse or recommend any individual or organization, including the speakers. CAMA Plan, its members, and employees do not accept liability for losses and/or damages arising from errors or omissions within, reliance upon, or any use of the information provided by the speakers. Individuals are strongly encouraged by CAMA Plan to conduct their own due diligence before making any investment choices. CAMA does not act as nor offer the services of an investment advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, the services of a competent professional should be sought. And if you have any questions following today's webinar about how to open up an account with CAMA Plan or anything else related to self-directed IRAs, Will Mucker, one of our client executives here, is a great resource for you. So there's his email. It is wmucker, M-U-C-K-E-R, @camaplan.com. And you can also call the number 866-559-4430. And with that, I am going to turn this presentation over to Ellis. Ellis, thanks so much for coming on today. You can now take it away.
Hey, Michael. Hey, everyone. Great to be here with you this morning. Yeah, let me get started here. Welcome. Great to have everybody. Hey, let me know where you're joining in from. I live in San Diego, California. I've been out here almost 10 years, reigned from the East Coast, South Carolina, and came out here about almost 10 years ago. So wow, we're almost on our 10-year anniversary, but would love to know where you're joining in from. Welcome, everybody. And really passionate about this topic, the idea of multiplying money. And I can assure you, if you stick with me for 60 minutes, we'll learn something together, something that you'll leave here better for, and hopefully able to accelerate your path, kind of wherever you're at in your journey. If you're in the beginning of your wealth building journey, or maybe you're further into it, today will be very helpful. I've been able to give this presentation once before, and it is gotten tremendous feedback. So excited to be able to share this with you today. So let's get started here. And I want to pull up the chat, because when I say that I like to be able to communicate with you, I'm serious about that, and I want to know what you're saying. So Michael, give me a sec here so I can grab the chat from everybody. There it is. So make sure you're responding to me so I can see you. All right. Screen share, here we go. How's that looking?
Looks great.
Okay, here we go. So why this topic matters, guys, the multiplication of money is the number one factor that you must know to build serious wealth. It is simply no longer enough to know how to make money, or it is simply no longer enough to know how to just make money, but have no clear strategy on how to create 2, 5, or even 10x returns. And you think about this for a minute. I mean, the way you know this is true is look at some of our larger professions. Look at doctors, attorneys, right? Other sorts of physicians, high income earners. How many of those do you know that are making great money and yet still are not really sure how they ever get off the wheel? I know many attorneys that are very disappointed with their financial situation. Is why a lot of them are clients. Okay, so let me just ask you a question, and seriously, I would love to see in the chat, or maybe you just kind of shake your head at home. Are you satisfied with your results? I imagine if you're here today, that even if you've had mildly good results, you're looking for more. And so will you agree that if you want radically different results from that of your peers, you will have to take radically different actions? Just let that sink in for a minute and just see if you agree with that. Will you agree that if you want radically different results from that of your peers, you will have to take radically different actions? And by the way, there's nothing wrong with that, to want something radically different from that of your peers. I know I did. I wanted something different from my family, from my friends. So let me just share a little bit about who I am today. I'm a former pastor. actually turned entrepreneur and investor. We run one of the largest faith-based masterminds in the country called Kingdom Real Estate Investors. It's an organization for active investors looking to really grow and scale their real estate portfolio. I'm the co-founder of a company called Symphony Capital Group. This is our syndication company where we work with passive accredited investors. And we've currently partnered with over about 100 investors. We own and manage more than $150 million of multifamily real estate, just over 850 units. And so this is, the experience that I've built and grown over the last several years to be able to teach what I'm going to share with you today. But I want to share a story with you first. And this is my first money mentor. Anybody want to share who their first money mentor was? Or maybe you look back and think about, man, this is who I started learning money from first. This is my dad. My dad retired at the age of 40. And although my dad was successful, he admittedly would say he spent his whole life trading time for money. And at the age of 55, my father unfortunately passed away due to a sudden stroke. What's interesting, what I remember most about his mentality in those 15 years, so he retired at the age of 40. He died at the age of 55. A lot of great memories, but what sticks with me is that I remember how much he still worried about money, even though he spent his whole life working for it. And looking back, I realized that my dad was incredible at making money. Like, he was a good entrepreneur. He owned a business since he was like 18 years old, and he ran that business. He was able to retire at 40. But this is what I also learned, is that my dad didn't know how to multiply it into his retirement. And that worry of not knowing how to multiply his money into retirement made him frugal. It made him stressed. And truly, it kept him from being as generous as I'm sure he wished he could have been. And so this is really, like, when I say my investing journey begins is when my father passed away, because my dad left me and my brother $147,000. And, like many Americans, I had no idea what to do. I mean, $147,000 was a lot for me at that age. I was a young man, probably not a lot to give away at the age of 55, but regardless, I didn't really know what to do with it. And so, like many, I trusted a financial advisor. And traditional wealth building advice tells us what? You've probably heard this. Hey, just put your money away for 40 years and wait. And let's hope that at the end of 40 years, I have enough to draw income on. Is that your plan today? Yes or no? Because if it is, I don't think hope's a great investing strategy. And it's much more likely that you end up disappointed. And I'll share why later. And then this happened. So I spent the next 6 years serving as a college pastor. So that's me with a group of college students at San Diego State University. Absolutely love what I did. Love these students. Love the ability to kind of be able to pour into them and share my faith and be able to answer, the bigger life questions with them throughout my journey. And one of the young men on my team came to me one day, about 4 years into our ministry. We were raising support. We were donor funded. And so it means we raised every dollar we needed to fund our ministry, to put food on the table, to take care of our families, to pay health insurance, like the whole 9 yards, right? And one of the young men on my team, he had been a student. He graduated from San Diego State University, came on our team as a college pastor as well. And one day he comes up to me and says, Ellis, I'm struggling. He says, I don't have enough money this month to buy groceries. And in that moment, I like to say my entire mission changed. And I committed to learning about money because I realized that here was a guy who had great faith, who wanted to live his life for a great purpose, who loved God and loved others. You know, the one thing that he needed in this moment? He needed more money. And that's when I made a commitment to learn how to make it, how to multiply it, and ultimately how to make money matter. And that really is the mission behind all that we do in all of our companies, is to either do that for and with others. And so what did I do? I made that commitment, but here's the thing. I was a college pastor. My dad had already passed away. I didn't really have like new money mentors. So I went back to where my money was, like the little bit of money I knew that I did have, the $147,000, right? I'd given it to a financial advisor. And I was hopeful that because I followed traditional wealth building advice that things would have grown. But do you know what happened? Anybody want to guess in the chat? Nothing happened. Like nothing had changed. And I believe there are millions of Americans today who can relate to this story. And so what went wrong is that I fell for the two lies of the financial wealth building sector. maybe lies that you have been taught to believe as well, or you see others believing. And number one is that you sit it and forget it. And I know this, that lie of sit it and forget it is not to benefit you, but rather to Wall Street, because the longer you stop paying attention to your funds, the more they can earn their fees. Because no matter how well your portfolio does, this is how Wall Street operates. This is the difference, in my opinion, one of the biggest differences between public markets and private markets is that public markets are collecting their fees no matter what. We could do public markets like this, right? Public markets are collecting their fees no matter what. Private markets are much more aligned with the investor, in my opinion, in most cases. Not always, but in most cases. Because the longer you stop paying attention in the public market, the more they can earn their fees. Myth number two is that what worked for me and what worked for my parents will work for me. And guys, this is why I know, like, if you just kind of have the sit and forget it mentality, you better wake up, because the target is always moving. What was enough, for your parents, or even what was enough to retire 10 years ago. Think about what just happened in the last 4 years with COVID and the amount of money that we printed and put into our supply system. What was enough 5 years ago is no longer enough today. And so the target is always moving. And I can assure you, probably in all of our lifetimes, this will not be the last time we have a major money printing event. We've already had 2 of them in the last 15 years. And so what this meant for me is that ultimately my investing strategy was based on hope. I was heading down the same path of all my money mentors: average results, average wealth, average life. And if I didn't begin to take radically different actions than those around me, there would be nobody else to blame but myself. I'm grateful a lot has changed since then. This is what we're going to talk about today. I have picked a better vehicle. I found better mentors, and these decisions have changed my life forever. This is my family. Our little boy is missing in this photo. He wasn't born yet. That's my wife, my daughter, at a Yankees game. Not really a Yankees fan, but it was memorable moment to go there. My daughter, her name is Ruth, and she was actually born on Babe Ruth Day. We did not plan that. That just happened. So listen, a lot has changed since then. We built a high 6-figure online education company. We purchased more than $150 million of commercial real estate. I was named 2020 Investor of the Year by Think Wealthy magazine. My wife and I have started our family, and she's had the ability to be able to quit her job. And we've helped more than 100 investors multiply their money and start their journey towards financial freedom. And so how does this apply to you today? I know that all of you are here today because you want options for your life. You're here because you want more options. Ask yourself the question if knowing how to just make money and not multiply it will get the results you want in your life. Don't be like my dad. Because typically we realize this later in life when it can seemingly be too late. And here's what this is where I hope you just kind of wake up, is that your current vehicle, your 401k, your IRA, the traditional wealth building advice that so many of us had followed until webinars like this existed, will never get you the results you dream of. And the way that I know that, the way that you can know that and test that, is just look around, guys. Look at what your parents accomplished. Look at your friends. Look at pretty much everyone in your network. It's destined for average results. And I know that nothing will change if you don't begin to take wildly different actions than all of those folks. And so this is a buddy of mine, Chris Underwood. He's the 38th winner of the Survivor TV show, $1 million cash prize winner. I think he said after all the taxes, he got about 600 grand of that, maybe even less, 500 grand of that. Top solar sales manager, one of the top solar sales managers in the country. He says, I'd rather scale my income and invest it in real estate that's turnkey and managed by a world-class team, a portion of my net worth, parked in long-term appreciating assets like multifamily is the perfect diversification for where I'm at in life. So guys, here's what we're going to cover today. Actually, we're not going to cover any of those things. I changed my mind last minute. We're going to cover this. I want to provide you with a very simple framework, okay, that anyone can follow in order to grow wealth faster. And so here's what we're going to cover instead. I'm going to cover these 3 things. This will be a very simple slideshow. How to make it, how to keep it, how to multiply it. I'm going to tell you a few stories. And I believe today that if you just listen to me for the next 15, 20 minutes, if you can take away one action from the make it, keep it, multiply, and how to make it matter, that your life can be different as well. So you guys ready to get in? All right. So make it. I don't know where many of you are today. Maybe you're in retirement years. This is my father-in-law, and a great guy. He's been a full-time vocational pastor for, close to 40 years now, and just an incredible guy. Loves people, really sharp, really smart. Has about 8 books in him that he needs to write, and has developed an incredible set of skills, both speaking, both social, both just he's an incredibly sharp guy in his 60s. And we were having lunch not too long ago with our family, and we were talking about some of the things we were wanting to do, and I asked him how he felt about that. He's like, that's great. I don't know how much we'll be able to participate because I'm going into retirement, and my income is going to be limited. And I thought that was a really interesting thought, because I'm an entrepreneur, and I know that that's not how money works at all. And I just asked him, I said, why do you think that because you're retiring that your income has to be any different? He's like, well, that's how the system works. So I was like, no, that's how the traditional system works. I was like, but you've have 40 years of experience. You have 40 years of incredible value that you've learned to provide to people. Why do you think that your income has to be less in retirement, not more? Because what I know, that in a capitalistic society, the society that we all live in here in the United States, money is tied to one thing: it's tied to value. And that he spent a lifetime acquiring skills and knowledge that the marketplace wants. And here's what I love about business: that unlike sports, when your knees go bad, your back goes bad, you can play business well into retirement years. And I just want to give that to you today as maybe a vote of confidence for some of you, maybe who are approaching those years and thinking like, man, my money, my ability to make money is going down, my timeline's going down. That is not true. That is not true. And that it is likely that God has not only gifted you with skills and an identity that is of value, but you've probably also acquired skills and an identity over your working career that the marketplace wants. Okay, that the marketplace wants. And so I just want to give you that vote of confidence, just like my father-in-law, that your best years are not behind you. With the internet, with the way the marketplace is today, with how many opportunities there are to bring your value to the marketplace, I believe your best money-making years are in front of you. And in order to build significant wealth in your lifetime, you do have to make money. Income is a big part of this. So that's all I want to share with Make It. Keep it here. Here's what I want to share with you today. We'll kind of get into more of this. There's 3 wealth killers, in my opinion, that can be detrimental to your wealth building career. 1 is taxes, 2 is fees, and the 3rd is divorce. I won't talk too much about divorce today, except to say, like, date your spouse. I believe, I read a statistic that if you actually give someone a hug for 10 seconds, it actually releases a chemical in your brain that makes you more happy. Isn't that crazy? That if we were just to take 10 seconds a day and hug someone, hug our spouse, hug the ones that are close to us, that our body is actually designed in such a way that it would release a chemical in your brain that would make you more happy, that would make you feel more connected to those around you. Doesn't take much to be intentional. But what I'm going to talk more about today is taxes and fees. And I'll tell you a quick another story. So it wasn't long ago. It was a Thanksgiving, I believe, and I was having family game night with the in-laws. A lot of good money lessons come from my in-laws. And so we were having family game night with the in-laws. And I don't think the game was Monopoly. It was a different game that none of us had played. And so before we started, I took the time to read the rules because I had never played the game. Maybe they had played. And I said, let me read the rules to the game so that I know what's going on. And so as the game progressed, I started to gain what seemed like a very unfair advantage. I mean, it was fair to say like I was crushing my in-laws and my family. However, I was simply just following the rules that no one else had cared to read. And I don't know if it's because they had been playing the game for so long or they just got lazy and didn't want to read the rules. But because I had read the rules, I knew things about the game that no one knew. And I was destroying everybody. And here's what happened. So interesting. I first was accused of cheating. I, the only person who actually knew the rules of the game, was accused of cheating. Then my family proceeded to make up their own rules to disadvantage me. Because they couldn't actually beat me at the rules of the game, they were like, we need to make up our own rules so that we can get ahead of Ellis. However, We all had the same rules from the beginning. Guys, how does this apply to never ever paying taxes? I want you to just look at some of the headlines in the recent year of what we've seen from this current government, from this current administration, and look at some of the headlines that we've seen recently. How the ultra wealthy devise ways to not pay their share of taxes. The richest Americans pay almost no income taxes, report finds. A report from ProPublica illustrated how wealthy people in the U.S. are able to avoid income taxes by keeping the bulk of their wealth in investments that have little or no taxes. What evil people they are to have read the rule book and have the bulk of their wealth in investments that have little or no taxes. Biden calls for new taxes on the wealthy. Biden's better plan to tax the rich. His budget proposes a levy on unrealized capital gains for high net worth households. So because we actually can no longer, because they're gaining such an unfair advantage, let's change the rules. Instead of taxing people on when they sell their assets, let's propose a new rule that taxes wealthy folks for not selling their assets, for just being good investors. See the similarities? And here's what I know, guys. The rule book was written by landowners for landowners. And if you want to win the game, you need to own real estate. Plain and simple. This is a K1. If you've never invested in a private, placement offering, you typically get a K1 at the end of the year, or before, for your taxes as a tax document, and essentially it just shows your share of income, deductions, credits, etc. from the deal. And this is a K1 of mine. I want you to see this down here, okay? I contributed $100,000 to this deal on 9/24/2021. And by 12/31/2021, so what is that? October, November, 3 months later, my K1 showed that I had lost almost $70,000. Now you might be thinking, Ellis, that was a bad investment. However, this deal pays me every single month. So how am I able to get a $70,000 write-off even though I'm cash flowing on this asset? It's because we benefit from the write-offs, including depreciation, bonus depreciation, which is something that I love about multifamily and we can take advantage of. Property and mortgage expenses. All of these result in tax-free income. And if you're working with groups who are actually, and you're investing in larger assets, we can take advantage of even outsized losses through bonus depreciation, which is what we did here in this case. Strategy number 2, I'll kind of skim through this. I focus on value-added real estate so we can do cash-out refinances. This is considered loan proceeds and therefore non-taxable income. And then if and when you do sell a property, there's things like a 1031 exchange where you can roll your proceeds into another asset and avoid capital gains tax, guys. So these are great strategies as you think about what real estate, what assets allow you to do in order to not pay taxes. The other thing here, I say this is confidential, top secret. This is another strategy I think every single person, if you're serious about building wealth, should begin to consider over the next several years, okay? And this is real estate professional status rep. So real estate professional status enables you to convert otherwise passive losses to deductible ordinary losses. That means you can use, because if you're not a real estate professional, all of the losses I just showed you, you can only use that against passive income. Okay, you can't just write off all of your active income from your losses. But if you're a real estate professional, guess what? You can. Meaning potentially lower your tax bill down to $0. And so who is a real estate professional? This means over half of your personal services you perform during the tax year were in your real estate business. You work more than the minimum threshold of 750 hours during the tax year, and material participation in these real estate activities. So examples could include an agent, property manager, asset manager, an investor, a construction manager. And here's the thing, if you're married and you file jointly, your spouse can qualify. So the bottom line is this, is that consider this a 5 to 10 year strategy. Like I'm not saying not everyone can just go do this in the next 6 months. Not everyone can just go do this in the next year. However, some of you could. Like some of you could go get a real estate license and become, a real estate professional, or your spouse could if they work from home or they don't work. Or the kids are about to get out of the house and you're looking for, that next career. Well, if you spend half your time as a real estate professional, this is a massive opportunity here. And so bottom line is just consider this, like talk with your CPA about this, is like, how do we begin to move to this into retirement? Because this is really, really massive. And you think about $1 million of savings over the course of 10, 15, 20, 30 years. The compound interest of that is huge. You guys still with me? This is a headline right here. Trump paid no federal income taxes in 10 of the past 15 years. No doubt, because he invested in real estate. However, this is not just for the ultra wealthy. Okay, this is Keith Meyer Sr. He's an investor of ours. He's a real estate broker in New Mexico. He says, in my case, I'm looking to use accelerated appreciation to offset income by getting a K1 that shows losses for the year that offsets some of the income that I have. This is Albert. He's an oil and gas attorney. He owns mineral rights, and then he also invests in real estate deals with us. He invests in multifamily deals, and then he uses the depreciation to offset his passive income from his mineral rights. So again, great strategy, not just for the wealthy, but also for average, I say average, at least not the ultra wealthy, for these wealthy men as well. All right, we're almost finished here, bringing this home, how to multiply it. If you're still with me, let me know here. Making sure we still got some folks with us. Yes, we do. Okay. So multiply it. There are two types of investors. And I love this meme right here. It says, there are two types of people in the world. Which one are you? I think this is so funny because if you I don't even have to explain this photo, right? Like, you know who you are and who your spouse is. And it probably has caused division in your household. But that's not what I'm talking about today. I'm talking about a type of investors. And when I'm speaking, I've spoken to hundreds and hundreds of investors, and we've worked with more than 150 at this point. That I know there are two types of investors, and the two types of investors I can now distinguish are those who make their money from their business or their job, their high income earning job, and then there are those who need to make money from their investments. So those are the two types of investors: those who make their money from their business or their profession, and then those who need to make money from their investments. And it's very two different type of people, because if you make your money from your investments, then you inherently have to take on more risk. It's no wonder why many people have been lured towards the promises of crypto, NFTs, meme stocks, right? We've seen all these crazy headlines of GameStop and all of this. And, you think about this NFT crave that, went crazy during COVID. Why? Because all of these folks who were getting these government stipends, they weren't making money from their professions. They weren't making money from enterprises or business ventures. They're looking for different ways to make money from their investments. And I don't know if you guys have read this book, The Psychology of Money. It's it really is timeless lessons on wealth, greed, and happiness. I think it's a fabulous book, one of my favorite money books out there. And the thing that I took away from this book, and has really shaped my investment thesis, and I hope it shapes yours today, is that he says, and I think this is the whole premise of the book, it's not, the goal of investing should not be just to make the most amount of money on your investment deal. He says the key to sustainable wealth multiplication is to make the most amount of money for the longest amount of time. And I think that is so key. And I'll show you a little graph. And this is what I look at when I'm looking at investments. I'm like, okay, time and years. So there's predictability. How likely are we to actually build wealth? And how much? And that's why I think NFTs are way down here at the bottom left. Like, we don't want to be at the bottom left, right? Because there's no predictability, and the payoff is typically very low. Bitcoin, depending on how long you hold crypto or how long you're holding Bitcoin, it could be a very profitable investment for you. But how predictable is it? We've seen that it is not a predictable asset. So I'm not saying it's not a good investment. I'm just saying, no, that's where it falls. Yes, it could it pay off? Sure. Over how long and what's the predictability? It's not typically what I want to be investing in. It's, can it get you there? Yes. Are there more predictable ways to get you there? Yes. And that's my point. The S&P 500, over a long enough period of time, will it make you decent money? Yes. I think the average return of the S&P 500 are around 8 to 9%. So over a long enough period of time, can it help you build wealth? Yes. But guys, there is no doubt that commercial real estate is by far the most predictable and greatest wealth builder of our lifetime. I love the quote that liquidity is made in the public markets. It's why people invest in the S&P 500. It's why you might own mutual funds, because if you need the cash, you can get it. Guys, but wealth is built in the private markets. And that's what the wealthy know. And so I want to give you a couple things that you need to know if you're going to invest in real estate after this webinar. This is what I've learned over the last 4 years and working, and buying over 1,200 units, working, we've raised more than $20 million of equity. We've invested a lot of cash. We've done a lot of deals. We've seen a lot of things. I've seen a lot of things go wrong. I'm seeing things go wrong in full transparency right now. So no, I don't think anyone will come out of this unscathed. Here's what you need to understand that most investors don't understand about real estate is debt. And I'll give you a great example. Look at the 08-09 real estate crash. What happened to the real estate? Drive down the streets today in Phoenix and Las Vegas and all these markets that had, huge losses. What happened to the real estate? Nothing happened to the real estate. It's still there. What happened is that people lost all their equity. Why? Because they didn't understand the debt product they had on the real estate deal. And the biggest mistake most of my clients are making before they meet me is they're making a 3-year bet when they're really looking for a 10 to 20-year investment. And I think that is so, so key. That you want to make sure you're aligning your investment goals, if you're going to invest in real estate, with the financial product that's supporting that deal, because not all real estate is made the same. Not all debt products are made the same. And so do not make a 3-year high-risk bet. Real estate can be risky if you use the wrong debt products. And so if you're looking for a 10 to 20-year investment, don't make a 3-year bet in real estate. So guys, here's what we covered. I'm happy to answer more questions at the end of this webinar with you. Okay, so the Think Wealthy formula: make it, keep it, multiply it. Money is tied to value. If you want to win the game, own real estate. Invest in your marriage. It was a quick one I threw in there. Two types of investors: be the one who makes money and owns assets. Okay, be the one who makes money and owns assets. And I'll end with this, guys. The real thief of my dad's retirement years was not his stroke, because death is going to get us all. The real thief of my dad's retirement was worry. And he needed a money mentor to help create a blueprint, to provide connections and alternative opportunities for him. And so the only thing I have to offer you today is if you'd like to jump on a call with me, I'm so grateful that Michael and his team allowed me to come on here. I will do a one-on-one investor blueprint call with anyone who would like to schedule a call with me this week and early next week. I have opened up some availability this morning on my calendar. I don't typically take a lot of these calls, but again, I'm honored to be here with you. I enjoy taking many of these calls up front. It gives me a chance to meet many of our investors, hear what you're looking for. And if we don't have opportunities, we do have an opportunity actually available today that we can talk about. It's a 12% preferred equity fund. But again, the goal here is just to meet you, to hopefully provide some strategies for you, to answer any questions. Because I don't feel like, again, where do you go to learn this? Who do you go to actually learn this from? And a lot of the folks even running these large real estate companies are not that accessible. And the good thing for you is we're not that big yet, so I'm probably more accessible. So anyways, feel free to scan this. You can also go to symphonycapitalgroup.com, and on our website you can schedule a call. I believe our website is symphonycapitalgroup.com/schedule. And you can find my calendar there as well. But I'll leave this up here for a minute. If you have your cell phones, you can just scan that with your phone. That should pop up my calendar, and feel free to book a call with me. And if they fill up, they fill up. I'm sorry, but for those of you who are here, would love to be able to do that for you. And if you're watching the replay, just go to symphonycapitalgroup.com/schedule, and you can find that link as well. If there's some times on the calendar, I'd be happy to meet with you. So guys, I have a few minutes. I'd love to take a few questions. I know we covered a lot this morning around this idea: make it, keep it, multiply it. Steven, I see your agreement in the chat. I think that was around the idea of debt and making a long-term investment. So Awesome to see your support there. But Michael, if you have any questions or if the group has any questions, would love to take a few minutes to answer some of these.
Yeah, I mean, whoops, moved my mic. First and foremost, I mean, how often are you working with self-directed IRAs and 401ks in this realm?
Yeah, it's such a great question. This is why I love this webinar format, and really, it needs to be a point in my slide of IRAs and self-directed things. Yeah, I kind of just assume that it's part of your strategy because I think it is one of the best things you can do. Is we work with many. I mean, I would probably say a quarter of our investors, or at least growing to about 25% of our investor base, now invest with self-directed IRAs. Because it's such a great vehicle, right? It's low fees. It's the ability to take sleepy money. I call it sleepy money or dormant money, and accelerate those returns, right? And here, let me just, for your audience here, like let me just quiz you. What has been your annual return the last 2 years in your retirement accounts, your IRAs and your 401ks? Do you know? And I would, and if you know, I would love to know. If anybody actually knows, please put it in the chat. Do you know over the last 2 years what your annualized return is in your retirement accounts, your 401k, your IRA? If you do know, great. You're about 1% of the people that I meet. Let me ask you this. Do you know what fees they're charging? Do you know what fees your 401k is charging? Do you know what fees your IRA is charging on that money? I've never met anyone in 4 years who can answer both of those questions. And remember that the two biggest killers of wealth are taxes and fees. And if we don't know what we're earning and we don't know what we're being charged, do we actually even know where we're heading, right? And so that's why I love self-directed IRAs, 401ks, and what you guys do, Michael, is because it actually puts you in the driver's seat. It puts you in control of your retirement funds and actually allows you to focus and know what you're investing in. And your fees are very transparent, right? This industry, in my opinion, yes, you have to charge fees because you run a business, just like we charge fees. We have to run a business, but I think they're very reasonable. They're very transparent. You know what you're getting, and it's not always baked into the upside. So definitely work with a lot.
Yeah, and something else you mentioned there really stuck out because it's something that we like to preach a lot, which is hope isn't a strategy.
Yeah.
I mean, I don't think we could agree with you any more than that.
Yeah. If there aren't, one thing I can talk about, we're in the multifamily space. How to use depreciation inside of an IRA. Michael, I'll let you take that one. It is a lot harder, or maybe impossible. You want to speak to that?
No, I don't.
I would
don't
say,
have I don't have a good way to answer that. That would be a question for Will, our client executive.
Mark, here's what I know, and I've done this a lot. It's not a huge value to you, actually, because if the IRA is investing, the depreciation would have to be allocated to the IRA account, and it is just not. It's really not applicable. It's not beneficial. I think you have to parallel these strategies of, hey, I'm investing. I can invest in own assets like real estate and get depreciation. I can also use my IRA to invest in stuff, and then those returns come to me in a tax advantaged account. So you have to kind of think, not everything is just invest in your IRA, right? That's why maybe a one-on-one strategy call is helpful. It's not like IRA or nothing, but I think it's part of the layered strategy of some of my money needs to be invested in an IRA account because that money's coming back to me tax advantaged. If it's in an IRA account, right, I'm not being taxed on the returns I'm getting, at least not now. If it's a self-directed Roth, then maybe never. And then money outside of the retirement account also needs to be invested, right? And you need to be investing money outside the retirement account so you can leverage depreciation. So I always like to say it's not an all or nothing. It needs to be a layered approach as you think about investing. And so, that is the downside of using a self-directed IRA. So it's not all or nothing in my opinion. So I hope that answers your question, Mark.
Well said.
Yeah. And I'm not a CPA or attorney. I've just done this long enough to know what's helpful for investors.
That is why we throw that disclosure at the beginning.
Yeah.
Very important to note.
And as we're kind of gathering some, a lot of things on multifamily right now, we still, I still like the multifamily real estate class. I see a lot of deals. I see a lot of things out there. I think it's important if you're looking at multifamily deals right now. I'll just give you some other tips. We're definitely seeing a slowdown in rent growth across the country. I've seen some data points lately. And so I would just say, if you're looking at multifamily or any asset class, in that opinion, self-storage, mobile home parks, really anything, is, understand the assumptions that the sponsor or your underwriter is making if you're doing your own deals of, a lot of these value, really anything, right? Everything is value add. We're never just buying an asset and letting it sit there. We're always adding value in some ways. And so I think the biggest question you want to know right now in looking at deals is just what assumptions are they making over a course of 3 to 4 or 5 years that are affecting the business model, that are affecting the returns on your investment. And do you agree with those assumptions? Does the market agree with those assumptions? Because if they're coming out and saying, hey, we're going to grow rents by 6, 7, 8% over the next 3 to 4 years, I just tell you right now, the data doesn't support that. Right. And so, or, hey, we're going to assume that interest rates are going to be cut in half 24 months from now. Well, yeah, I mean, trust me, if there's anybody who's praying for that type of relief, it's me. But I'm not assuming that in future deals. And so you need to understand what assumptions are people making in their underwriting that are impacting your overall returns. Because just because they say 15 or 18% annualized returns, hope you understand by this point, that doesn't mean that you're automatically going to get 15 to 18%. A lot has to happen for you to get 15 to 18% on your money in a real estate deal. And
Absolutely.
so really key to just kind of ask some of those questions. The biggest question I think anyone can ask, that you can ask your sponsors or ask folks you're investing in, is, hey, what assumptions are you making? What assumptions are you making about rent growth? What assumptions are you making about interest rates? And that will tell you a lot about how prepared that sponsor is. Because we do in our company, we do a lot of direct investing. So we own and manage real estate. We also do a lot of capital placement as well. So we're doing both, right? We're vetting sponsors. We are a sponsor. So I've done it all, and kind of can speak to both cases.
Well said. If there are any more questions, feel free to put them into the chat now. And if not, you can always reach out to Ellis afterward. You can also reach out to us afterward. Stephen did thank you for the presentation, and looks like he's going to reach out next week.
Yeah, there you go, guys. I dropped my link in the chat, symphonycapitalgroup.com/schedule. And Michael, thanks again, man, for y'all's work and serving investors. I feel like we're, kind of Batman and Robin. I'm more like Robin in this case. And so thanks for your y'all's work too. I think, again, it's we all kind of need each other, I think, to serve investors and help people realize what's out there. So thanks for, taking the time to put this webinar together, and glad to be able to provide some value.
Well, thank you for coming on, and God help Gotham if I'm Batman. That's all I have to say. We're in trouble. But thank you so much for everything. I learned a lot today, certainly, and it sounds like the chat did as well. And yeah, I expect you'll probably be getting some calls pretty soon.
Awesome.
So thank you.
Thanks, everyone.